Dividends. What are they? Everybody has heard about dividends, but not everybody knows what dividends are, why companies pay them, why people invest into them, and what common things like dividend yield and payout ratio mean. Now in this video we're going to tackle everything, all the questions that you might have about dividends, so you understand what dividends are and why you should or shouldn't invest in them. Now let's start at the very basic. What is dividends? Dividends is a company that pays out a part of their profit to the shareholders in form of dividends. So they give you a piece of the money. Now, so you own, for example, a share of Coca-Cola. Coca-Cola makes a profit and gives out some of it to you. Now, how often do they pay those dividends? Well, it depends on companies. Some do it monthly, others quarterly, and others do it yearly. Now, if you buy a share, there are two things that you need to consider. First up is the ex-dividend date, and next up is the dividend payment date. Now, what's the difference between those two? The ex-dividend date means that in order to receive the next upcoming dividends, you need to own that share before that date. So let's say the ex-dividend of a Coca-Cola share is on the 30th of July. That means you need to own that share on the 29th of July in order to receive the next coming dividend. Now the dividend date is when the next dividend will be paid out. Let's say, for example, the 4th of August. So if you own the share at the 29th of July, you'll get your first dividend at the 4th of August. Now, if you buy a share after that, which is also fine, it can happen, but it means that on the 4th of August, the previous owner of that share will still get that dividend, but the next dividend will be for you. Now, how much dividend will you actually receive? Again, this varies per company, and you can see how much they will pay out according to their dividend yield. So let's say they have a dividend yield of 5% and the share is 100 euros. That means you get 5 euros into your account, which seems like a nice amount. Now, most people tend, when starting out, to look for the high dividend yield stocks. The higher the yield, the more money you get, right? True, but this might be a trap. Now let me explain why. So some companies, they pay out a large dividend because they have been over years, but when the economy is doing bad, they don't want to cut on dividends. So they take out loans or they take up their savings in order to keep paying dividends, which is of course isn't great for their stability. That's one reason it might be a trap. Second, some companies, they make a large profit through the year and they want to pay out a one-time only high dividend yield. So if you don't do your research, you see it has a high dividend yield for that year, you invest in it, and after that year they cut dividends back to the original one, which means for you a loss in dividends if you didn't do your research. So that's why you shouldn't always look at higher yields. You should look at the lifetime of that company, how much did they pay and how much yield do they give. Now another aspect you can look into is their PE ratio or the payout ratio. Now this is also a percentage. A healthy percentage is usually between 60 and 70%. That means that between 60 and 70% of their profit will be paid out in dividends. That means they still have 30 to 40% for savings, for investments, or for anything that they need money for. High payout ratios like 90% can indicate that a company is struggling and they're paying way more dividends than they actually could. So be wary of those. Now that is in a nutshell what dividends are. Now let's get behind the reasoning why people want to buy it, but more importantly, why do companies pay dividends? We'll first go for why people invest into them. People invest into dividends because they get paid an amount of share. They can see it a little bit like a salary. So if you invest $1 million into stocks and you get a 4% yield, you get around 40,000 a year, which sounds quite nice. But keep in mind that dividends can be cut, they can even be totally stop paying dividends. So it's not always this big, massive dream that people have, but you need to take into account that things might change. Now, another thing to notice is that if you are investing or accumulating, investing, distributing dividends, it doesn't matter, is the goose versus the eggs metaphor. Now, what does this mean? It means that you should live off the eggs and not off the goose, because the goose is providing the eggs. Now, in our case, that means that you can live off the dividends at payout instead of selling off your portfolio. So it can be quite good if you know what you're doing, but keep in mind that inflation still will hit, and if you take everything that the dividends pay out and you take it in and spend it, then eventually you will decrease the money. So a healthier way would be to still keep investing 1-2% of the dividends, and the others you keep for yourself. But that is of course depending on the goals that you have and what you want to achieve. Some people even might want to spend or sell their entire portfolio for that 1 million, 2 million or whatever, and just go on a massive trip and enjoy life to the fullest, which is also completely fine if that is your goal. But now, why do companies pay dividends? It seems to me, especially in the beginning, for me personally, I thought of it as companies just giving away free money with no real benefit to the company itself. So I always wondered, why do companies do this? Now, companies have a few reasons to start paying out dividends. First up, it signals that they are financially strong. They don't need to reinvest a lot anymore because they, like Coca-Cola for example, they already have worldwide spread, they are massive, and they have only a few products. There's not much more they can grow into, so they're stable enough with enough income to start paying out dividends. Now, this is when the company already pays dividends. But what gives a company a reason to start selling off shares in the first place? Now, you can look at it this way. For example, you're starting your own company. You are 100% the owner of a company that makes $1 million a year. Quite nice, right? You earn $1 million a year, and that $1 million is complete profit. So all expenses paid, you paid your own salary, and that's just $1 million profit for the company. Now, you are a business person and you want to grow your company. So you stay the course, you stay 100% the owner, you make all the decisions, and you just keep working towards it. Now, after 20 years, you might end up with 100 million a profit a year, which is actually quite a lot and a really good profit. Now, let's look at person number two. Person number two has the same situation as you. So they are 100% the owner, they make $1 million a year, and then they decide to start selling off shares. Now they go public and they start selling shares. They sell 10% of their company. Selling 10% of their company nets them 100 million at the very start. This 100 million can be invested back into the company. It can buy another company and take it over, make new factories, new personnel, new employees, everything. Now that same person after 20 years now makes 500 million a year. But selling off 10% means that 50 million goes back to the shareholders, which still leaves person 2 with 450 million a year instead of person A, which 100% owns the company, with 100 million a year. So that's a reason people might go public with their companies and sell off shares. Now, of course, person 2, even though earning a lot of more money, has to trade off 10% of the profit back to the shareholders, and they might even go for selling off more shares for an even bigger investment. So it's kind of a trade-off. You either sell off something of your company, get a large amount of money to grow your company rapidly and earn a lot of money, which can also backfire if the investments go wrong and whatever, so it's always a risk. or you stay in total control, but the growth might end up be slower than selling off shares. So this is a little bit the psychology behind why companies would or wouldn't pay dividends and sell shares off. But now let's see what the taxes are all about. Now the taxes depends per country and per shares that you have. So for example, if I own a share of an American company, let's say Microsoft or Apple or whatever, if I get paid dividends, then US is going to be like, hey, before we pay out as dividends, you have to pay American taxes before we get the dividends. So you pay taxes in America to American. Even before we see the money, it's already gone, they took it, and then they pay it out to you. Now, in your own country, so I'm from the Netherlands, there also might be some extra taxes that you have to account for. For us Dutchies, it's your box 3, which is your total wealth of your assets, which you have to pay a percentage of to the government, and you have your dividend taxes. Now, some brokers like the Hero, they will automatically pay it for you. But others like maybe Trading 2 and 2, they don't, so you have to fill in the forms, your tax forms correctly, and you might end up paying a little bit of dividend taxes as well. So always do your research, go to a financial advisor around this. But the main thing to take home is that it varies per country. Now I know a lot of people, they like to invest in Irish companies because Ireland has some favorable benefits when it comes to dividends and the taxes that come along with it. But again, I'm not a financial advisor, so always do your own research on this topic, but just know it varies per country. Now, what about my personal opinion? What do I think of dividends? I think dividends are great. The first time I received a dividend, it felt so good seeing that a company actually paid me, and it was like 5 or 10 cents, I don't know, but it just felt so good that I was just getting, it was monthly by the way, that I was just receiving a monthly income. It was just paying me 10 cents. And with that dividends, I started to imagine the compound interest, the magic that everybody talks about when it comes to dividends. So I invest 10 euros a month, every month. And after the first month, I get 10 cents back from dividends. Now that 10 cents I can again reinvest. So the next month I can invest 10 euros and 10 cents. And the next month it just keeps going like a snowball rolling down a mountain and just keeps getting larger. And that's what really started to ignite that passion within me, just knowing that if you keep going with this, you'll end up with a nice amount and you can retire. Now, the thing with dividends is they are not volatile and it's a very low risk profile. Actually, the market and history shows that people that always stayed invested will have always made money, and dividends are the lowest risk that there is. Now, meaning at a low risk, it means you won't get rich tomorrow. Now, this will take time. You need compound interest to really kick in to start help you out. Now, if you want to get rich fast, then you have to take more risks and higher volatility markets like cryptocurrency, for example. Crypto, you can either become a millionaire in a day or lose it all the next day. And that's something that if you like that thrill and you think you know what you're doing and you've done your research, by all means, go for it. Always be careful. And again, this is not financial advice, always do your own research, but that's not for me. I like my income to be passive and I like to be almost guaranteed, because it's never guaranteed of course, but it's the safest way, and I just keep investing every month just to receive that payout dividend check. Now, there's also a difference between accumulating and distributing. Now, what does accumulating mean? For example, the VWCE is an accumulating ETF, or UCIT because it's European. Now, what does this mean? It means that if the companies within that UCIT pay out dividends, they never pay it out to you in cash. Instead, it buys more shares of itself, which is quite nice because it takes away some steps that you have to do in order to buy back those shares. Now, distributing means that the dividends you get paid out in cash into your account, and then you can reinvest it back into the stocks or pay it out to yourself if you would need the money or just want to have the money. So that's the difference between accumulating and distributing. Now, there is also something else besides dividends, and which is just the growth of your portfolio. So you can also invest in, let's say, the VWO or the S&P 500, and instead of getting the dividends, which accumulating has the same, instead of getting that 4% dividend paid out to you or distributing, you sell off 4% of the UCITS every month or quarterly or yearly, and that is your dividend payout. So if you want to have it automated, go for accumulating, and then once you're ready to retire or you need the money, you just sell off a part of that UCIT every month in order to get your money. And if you like seeing the money come in and having the ability to choose to do whatever you want with that money, go for distributing because it gives you more control. Now, if you have any further questions about dividends, let them know down in the comments, and I will try to respond to all of you to help you out on your journey and becoming more intelligent. Thanks for watching. See you in the next video.